Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is leveraging social media for real estate success. Social media isn't just for cat videos or vacation pics. It's one of the most powerful tools in your real estate toolbox. The right strategy can help you find deals, build your brand, and grow your network. Here are 5 actionable tips to make social media work for you. Number 1, pick one platform and master it. You don't need to be everywhere. Start with Facebook or Instagram and get really good at it. Number 2, share your journey, not just your wins. People connect with authenticity. Show the good, the bad, and the lessons learned. Number 3, engage consistently. Comment, answer questions, and interact with your audience. Relationships start with conversations. Number 4, use stories and video. Short videos and stories get more engagement than static posts. Don't be afraid of the camera. And number 5, highlight your unique value. What makes you different? Share your expertise, share your why, and your badassery. So, RAIN Nation, remember, your next deal or partner might be just one post away. Get out there, get visible, and let your badassery shine online. Now, on to today's episode of the Real Estate Investor Growth Network podcast. Today, we have with us Wayne Courreges III, a true leader in the world of commercial real estate syndications. As the founder of CREI Partners, Wayne manages over $60 million in assets across Texas, Louisiana, and Alabama, helping busy professionals build generational wealth through passive investing. With a background that spans service as a U.S. Marine Corps corporal and 16 years at a Fortune 125 commercial real estate firm, Wayne is dedicated to protecting investor capital, delivering high-yield returns, and giving back to the communities he serves. It's a pleasure to have him on the show, so welcome Wayne Courreges. The third.
Yes. Well, I'm not my grandpa and I'm not my dad, right? So I have to do
Exactly. You have to specify. Very good. Well, yes. Wayne, it's so great to get you on the show. Thank you for being here.
Thanks, Jen, for having me.
Absolutely. So I want to kick things off with your story. And first of all, thank you for your service in the Marines. We do truly appreciate you. But what inspired you to transition from the Marines to full-time real estate investing?
Oh, that's a lot there.
That was a lot, wasn't that?
That's a lot. Yeah. I do say like not as lean, not as mean, but still a Marine. So that's sort of what I go by. But yeah, I was served 2003 to 2007. It does feel like a whole another life ago. But
yes.
Yeah, I mean, I really started my real estate passion in high school. I mean, it goes way back then. There were some people in my life that were heavy real estate investors, developers in and around Austin. And so I was on a show yesterday. I thought it was a good analogy where that rich dad, poor dad was really prevalent during that time where, my parents did very well there. We both retired and both happy and such, but it was a different stress level and a different mindset and way of doing life than say the rich dad. Right. And so rich dad was doing real estate. And so anyway, that exposure at an early age made me think about real estate at obviously an early age as well. So I joined the Marine Corps 2 days out of high school. I actually
Oh,
signed up for the Marine Corps September of my senior year. Our family has a lot of history of service, and during that time was sort of at the peak of Iraq, and what was going on in Afghanistan. So I signed up early, 2 days out of high school, went and speed up to when I was 19 years old, bought my first single family home in 29 Palms at Lance Corporal pay. It's the time of day is like, remember like 07, 08, where like all these loans were going out to people that probably shouldn't have gotten them.
right.
I was probably one of those because I don't think I put any money down or anything. And like, we don't make any money. Maybe the pay's gotten better. I haven't looked, but I wasn't making anything. But anyway, that was really my start into investments. I was at 19 and I did sell that house. It wasn't at a loss or anything. So it wasn't like the horror stories that a lot of people unfortunately went through during that
Right.
time.
Yep.
But I joined CBRE right out of the Marine Corps. So this was 2007, and I was with them for about 16 years. So we were heavily doing operational, like asset management, working with like institutional clients, MetLife, JP Morgan, TIAA Craft, and others on their real estate holdings and working with them on their life cycle of properties. 2019, or actually probably like 2017, I decided to go back for my MBA while I was working, and that
Wow.
really brought up the entrepreneurial juices that I used to have. But when you work for a large company, those entrepreneurial spirit dies because your
Yes.
procedures, I'm sure many of your audience can
That
relate,
that
right?
light is dimmed. Yes, in
Yeah,
your
because
tiny little cubicle.
yes.
Yes,
But at the
keep going.
meantime, like, hey, it was taking care of my family. Like, it was such a blessing. Like, it was
Right.
that chapter was needed, and I have no regrets. I would not do anything different. But going back from my MBA, it did like spur up, like, oh, entrepreneurship and owning a business, and like, oh, I those feelings had gone away. That, like you said, the light was dimmed for a while, but not in a negative way. It supported the family and all that stuff during that time. But anyway, so 2019, I started CREI Partners, right? And we focused on multifamily. We still do. And honestly, the large part of that, Jen, was it didn't compete with the day job. So,
Nice.
right, CBR is focused heavily on office, retail, industrial, and so they weren't doing multifamily. So I got a mentor, dug really deep on multifamily, and in July of 2023, it just was too much to do my day job and at the time my night job because it was just like two full-time jobs. And so I went in all on myself in July 2023. And here we are in mid 2025. And
Yep.
we've got a couple of team members full time. And we're continuing to work hard for our investors.
I
That was a
love
lot
that.
right there, but that was a
No,
sad thing to do.
and I was like following everything along each step of the way. But I want to go back to when you were in high school. Who introduced you to the book Rich Dad Poor Dad?
Well, I didn't read the book Rich Dad Poor Dad
Oh,
in high school.
oh, gotcha.
It just later on, and actually, I've never given that analogy until yesterday. I was on a podcast and I gave that analogy. So now it's just stuck in my mind, honestly. But it really what, and we didn't talk about. I mean, it just was evident of like, I remember going to the country club with this individual, and I was talking to him about how do I become like you, like
Right.
the 16, 17-year-old who wants to be like someone else. And
So you're acting like
yeah,
you've
I mean,
lived it. You lived the
I
whole
lived it,
situation.
and he
Yes.
was right, and he told me own and develop real estate. And what his advice was like we lived in Austin, so buy on the outskirts of Austin, right? And of
Yep.
course, I wasn't able to do that until Marine Corps. I wasn't able to do that, and so it's easier said than done. And so those that are listening know, like, hey, it's not impossible. It just takes time and partnerships, and
Right.
we'll go through the team and all that, which are things that I didn't know about really until really like I said, going back for my MBA, it really pushed my entrepreneurial drive and opened up thoughts of like, hey, maybe I should be doing something different outside
Awesome.
of career.
And I like that you found a mentor because this isn't a lot of people think, oh, I'll just go to YouTube University and watch videos and all that fun stuff, which I mean, there's nothing wrong with that. But having that mentor there by your side to ask you those questions and take you along the whole commercial it's a totally different game. So I want to start getting into syndication, and that's what you
Yeah.
focus on with people in your company. So but I need you to break it down for the listeners. What does syndication mean? And then who are the key players in the whole syndication process?
Yeah, great question. So when I bought that house at 19, somehow I was able to get that loan 100% without anybody else, right?
Wow.
And it's my mom, dad, or anybody. Like I was able to do it on my own. And so what people do a lot of times is they get into real estate and there's not a right or wrong. There's different ways to slice a cake. It's all good, whatever people decide. But a lot of people they get into single family because they have a certain amount of money they're willing to put down as a down payment. They have a lender who's willing to give a loan, and so that's what they're able to do by themselves. And
Right.
so and that works for some people. For me, when I had that single family home rental, well, it's set for rent for like or vacant for like 4 months. And so I learned really quick that like the idea of a single family rental sounds good until there's nobody paying rent or that HVAC goes out, right?
Right.
So I wasn't into single family rentals much after that. So when I look at like multifamily really starts at anything above like 4 units, right? And so we're heavily focused on 100 to 150 units.
Nice.
And a lot of those properties we wouldn't be able to buy on our own, right? There's some properties I was able to buy on my own based on my net worth, liquidity, and such like that. But there's those projects that I wouldn't have. I don't. Lenders want to see at least, say they do a $10 million loan, they want to see at least a $10 million net worth, and they want to see at least 100,000 or not 100,000. They want to at least see like 5%, wherever that number is. Maybe it's like 500,000 on a 10 million loan. So whatever that number is, but they want to see that you have the liquidity and the net worth.
Right.
Well, depending on the size of the project, yes, I could meet that, but on other projects, I wouldn't be able to meet that. And so what we would need to do is bring in partners. And so that first partner, we're talking about a key player, is actually called a key principal. So if you're not able to bring the liquidity and the net worth, one of the things you're going to want to do is network and find people who have the net worth and liquidity. And I always like to use the analogy like a football team. I feel like I'm the quarterback. I can't throw a ball worth a damn, but like I love bringing people together. Like I need a solid line. I need the receivers. I need a good running back. We need the team, right? And so as a syndicator, you are the person that's bringing in the team to execute on a deal. And that deal that you're executing on is one that you wouldn't have been able to do without having others involved, right? You
Right.
couldn't do it on your own. That's the simplest I could say for it, is that you're pulling money from friends, family, and other people to help you with the equity, right? Your investors, in essence, limited partners. You're bringing in people, maybe you don't have the experience to run a multifamily or a retail center or storage, whatever it is. So you bring in somebody on your team to help you with that experience, the net worth. Ultimately, you're just putting all the pieces together so you can be that entrepreneur and buy that business. And in our world, that business is that real estate.
Got it. That was such a great explanation of it. I love the whole football team analogy. And so what would you be in that situation? Because you said limited partners. Give me some other of the key players.
Yeah, so limited partners, how to structure this. So when you buy a property, a commercial property, that typically is purchased through a special purpose entity, SPE.
Okay.
So you would be creating an LLC. Like you're in North Carolina, you would create an LLC, potentially in North Carolina. We do it in Texas. So we would have an actual limited partnership entity that would actually be holding title to the land or the property we're buying. And then there would be a general partner entity, which is typically an LLC, as the manager of that limited partner entity. So usually 2 entities per purchase that we're buying syndication. In that limited partnership entity, the LP entity, it could also be an LLC, or talk to your attorney based on what state that's for you.
Talk to your attorney.
Talk to your attorney. That's a team member.
Yes.
But for us in Texas, because we have what's called a franchise tax, the recommendation from our attorney was to do it as a limited partnership.
Okay.
For that entity. So that limited partnership then so you think about limited partnership as the umbrella, and then there are the managers of that partnership and members of that partnership.
Okay.
So limited partners are typically the equity investors. They're typically bringing in 50,000, 100,000. I've got $1 million plus investors. They bring in a portion of that equity to pull money together to be able to buy that asset.
So question on that, do they have to be accredited?
So great question. So all the syndications are governed by the Security Exchange Commission, SEC, and the SEC has regulations on that. Now, a 506B, Regulation D 506B offering,
Right.
the syndicator would be responsible for working with another SEC attorney or someone for the paperwork side. But the 506B allows you to accept 35 non-accredited investors. However, we would have to have a relationship, a pre-existing relationship before that offering was presented. Once that 35's hit, we're not able to bring in additional non-accredited investors. We can bring in an unlimited amount of accredited investors. You might ask, like, what's an accredited investor?
Thank you.
I don't define that. The SEC defines that as any single person not married earning $200,000 or more in income is considered accredited. Anybody that's married filing jointly at $300,000 income jointly are accredited, or $1 million net worth, excluding their primary residence, are accredited. There's also some exams that you could take, some tests and such. I think it's like Series 7. Don't quote me on that, but there's different. They have provided a little bit more latitude on that accredited status, but 99.9%, actually 100% of our investors fit either in that status of net worth or income, or have a pre-existing relationship, because we do sometimes do a 506B. And so those relationships are important to invest as long as we have a pre-existing relationship. So those limited partners, whether they're accredited or non-accredited, depending on if it's a 506B offering or a 506C, they would sit in that members. And that's important because limited partners are only limited to the capital that they put in. So from a risk standpoint, risk exposure, since they don't have control over the day-to-day, their risk and their exposure is the investment they put in.
Okay.
Right. And now the managers, that's where the general partners sit. So the managers and the members plus managers equals the entity that is buying that property. So that's as simple as I could put it. But yeah, and then the managers are responsible for day-to-day operations, signing on the loan, working through the business plan. And I think of them as the jockey on the horse. Those members are dependent on that jockey to make the best decisions,
right,
for that business.
So well said, Wayne. Thank you for breaking it down like that. And I mean, I love your analogies that you're using here. And because there's so many people who think maybe if someone passes away and they're left a chunk of change and they're like, I want to get into real estate now. And they'll take a course about how to flip houses. And they're like, oh, I really don't want to get my nails dirty. So this is a truly passive way for people to invest where they're parking their money. Now, if I had 50,000 laying around and you and I had a pre-existing relationship, or I'm accredited, whatever, what does it look like to me as an investor? I'm investing $50,000. How am I making money? How do I see if I'm making money? Do you have any type of software, portals, stuff for us to look in? So this is totally off topic of what questions I had here, but you're sparking so many other questions in my brain.
Yeah.
So
I love
how does it look like for the investor?
Yeah. So say you are ready to invest, say $50,000. We always like to have the pre-existing relationship. So there's always those relationships, whether it's accredited or not. It's not required for accredited, but we enjoy the relationship building because what we want to find out are two things. Three things. Are you a good fit? Are you a good person? Because we're going to be in a partnership in essence for 5 years. You want to know that about me. Are you comfortable with me as the jockey? Am I comfortable with you as a limited partner? Because if you're going to need that money next year, that's not a good partnership because I can't give that money's not liquid, right? So that's one. The other thing we want to find out, and those that are listening, is are you a cash flow investor or are you an equity upside investor? So just like stocks, there are risk profiles, and some people have a higher tolerance on risk depending on where they are in their investment cycle. So for example, we have 80% of our portfolio is multifamily. 20% is that speculative world where we're developing a storage facility, or we have a 150 unit multifamily under development, or a Spring Hill Suites under development, or an office retail under development.
Awesome.
More risk, hell of a lot more return.
Right.
That's 20% of our portfolio. That's my comfort. Just like in a personal stock world, like I'm okay doing 20% in these like growth stocks, these unicorn companies that I hope. It's like that's the portfolio. I'm okay with it being higher risk, higher reward. Then 80% of our portfolio is those day one cash flowing multifamily properties. And so those, when we have those type of opportunities and you're in our investor list, you get an email saying, hey, we're going to do a webinar. And that webinar, we bring in people, we present the business plan. And I think when people, we shouldn't think of it more complicated than it's just a business. That property that we are presenting has income, expenses, net operating income, the debt, and then after all that's paid is profit.
Right.
And so if you think of it as simply as a business, my job as a sponsor syndicator is to find the best businesses to buy. And I buy cash flow. Going back to our show, like we buy cash flow.
Yeah.
And so cash flow in the essence of real estate. So we present the opportunity, share the business plan, share about the team, share about the experience, to share about the value add, why we like the deal, all the stuff. So that's part of the webinar. From that standpoint, if you're ready to invest, then what the tool we have is actually an investor portal. It's through Cashflow Portal, where all of our investors have all their properties they've invested with, all the tax documents, private placement memorandum, all that is in a portal.
Nice.
There's no like DocuSign or outside the portal and like all the communications in the portal. We do monthly updates with monthly financials. We do all the K1s. We provide, so there's always that clarity there. Now, as far as the returns, what typically people would see in a return, at least on our syndication, is we do a preferred return model. And so that preferred return typically is a 7 or 8% preferred return, meaning Eugen would have to get if you invested 100,000, so you got that 8%, that 8%, 100% would have to be paid to you first before I see any.
Okay.
So there's a stick for me to pay you first before we get any split. And how that typically works is 100% up to your preferred return, and it accrues year over year. So like say year one, I only pay 4%. Well, then the other 3 or 4 goes into year 2 and it continues growing, right? So I like that model because some models, and this is where as the listeners meet syndicators, some of them just do a 60-40 split. Whatever the profit is, we split it 60-40, 75-25, whatever it is. There's not a right or wrong. It's just my comfort and where I feel like the best way to take care of my investors is to do a preferred return. Once they hit the 7 or 8% pref return, then it's split 75 to you, 25 to me.
Wow.
So it's still heavily regarded for the passive investor, and then we start seeing cash flow. And then once we hit 18%, it's split 50-50. The average annual returns over 5 years is typically 20%. And you think about it, it's the cash flow year over year, and then the equity upside that we get. So typically our deals are 5 years, and those are typically the return. Equity multiples typically 1.8 to 2x multiple over those 5 years. And what we're really not talking about, we're talking about a lot about cash flow, but the incredible thing about real estate is the depreciation and the paper losses.
Yes.
And so that was going down. I think this year was at 40% for 2025. Now it's gone up to 100%. And so it's incredible but people get confused, like passive losses offset passive income.
Right.
And then we can talk about the real estate professional status if you want. That's a whole nother incredible badassery thing there. But most people are going to fit in that non-real estate professional status world, which is still 100% depreciation, which is, I mean, that's why the wealthy invest in real estate or oil and gas and other assets that provide that depreciation.
Huge. Again, I love your answers. So what do the payouts look like? Is there one payout at the end of the 5 years? Why 5 years? Do they get monthly payments? Like what's going on with the payouts for that investor?
Yeah. So every sponsor is going to do something maybe a little different. Some may not pay the first distribution until 6 months after acquisition. We really try hard to find deals at cash flow day one. So we try to, we do quarterly. So the first quarter we'll do a distribution. So every quarter there's a distribution. And then at exit, there'll be a much bigger return because you have that equity build.
So why 5 years?
So really good question. So most commercial real estate loans are 5 to 7 year loans. When you look at like single family, you have a 30-year amortization, 30-year loan. In commercial, it's typically a 5 to 7 year. I also am not a very patient person. Like I do not want I don't want to have a property for that long. Because you think about also the repairs and maintenance over time. So we're buying 80s, 90s product, and there are people
Yep.
out there that buy like new product, right? And there's pros and cons, and we can go through that if you want. But like for us, it's 80, 90s because we find like, hey, there's enough value add. But if we put in, say, 500,000 in CapEx on exterior, well, that will be good probably for 5 years. And then after that 5 years, there's probably going to be another roof leak or another boiler issue or another something where I have to bring in more capital. So I think it's good for multifamily in particular just to have that 5 to 7 year refresh of cash.
Is it like
Uh,
a stabilization process or
it's not really
it's just the
stabilization, though, like just the
loan
loan.
situation?
Yeah.
Okay.
So it's typically amortized. So multifamily in particular is amazing on loans. One, multifamily has a 30-year amortization. Typically, like on my storage and office retail, typically that's a 20-year amortization. So you get a longer amortization, which means more cash flow. And your rates are typically it's non-recourse, typically fixed rate debt. And so you have a 30-year amortization, but typically a 5 or 7 or a 10-year balloon payment. So we just have done 5 years because in our hope, we're both cash flow and equity upside investors personally. And so that's why we're pushing a lot of these investments. So we'll do a 5 year hold and with the hope of doubling our money every 5 years. Sometimes we have to extend and maybe it's a 6 or 7 year hold, but because we don't want to sell in a market that isn't good. So
Right.
there usually is some flexibility with some type
Okay.
of year extensions.
Well, thank you for explaining that because I'm sure people are like, why aren't you holding this forever? So going back to my questions here, because literally now I'm on question two. Because
Yeah, no,
I
that's
just
good.
went total different direction here. So
Awesome info.
you've built CREI Partners into a powerhouse with over 60 million in assets under management. So for our listeners who are new to the game, can you break down what solid underwriting techniques really means? Why is it so crucial for a deal to work? That's a loaded
Hmm.
question, wasn't it?
So first off, if you're doing underwriting by yourself initially, like stop. You need to go back to that mentor.
Just stop.
And go find a mentor. It's more than
Yes.
just YouTube. It's more than that, right? Because you can plug and play into an underwriting, but it's an art. It's not a it's an art. And I have a hard time finding analysts who understand that it's an art
Yep.
because there's all these different levers, right? And this is where passive investors need to know what those levers are. For example, you've got income growth. What is a good projected income growth? Sometimes it's 0% year one, or maybe it's 2 or 3. I typically do 3% still because a lot of my in-place rents are still below market. And
Okay.
typically we see a 3 or 4% year over year growth. Some people don't like that. They're like, no, I'm going to be super conservative. I'm going to do a 1 or 2% year one because rents are flat. I've never had people, if they're going to move, they're moving because they're relocating or whatever, but they're not going to, if they're already below market, they're not going to balk at a 3% increase,
Okay.
knowing that the next door neighbor, like going to another property, is going to cost them moving fees,
Right.
going to cost them time, stress, and then they're going to have to pay a new security deposit, and then they're going to have to sign or a new lease that's going to be market. So I typically would do that, but that's something from a passive investor standpoint because I like to really educate on the passive investors, even though I know some active investors are likely listening in. Active meaning they would be doing what we're doing as a
Mhm.
sponsor. But being conservative on rent growth is one. Cap rates is another. For those that are not familiar with cap rates, like it is the business multiplier on our world of value. So like if a cap rate is at a 6% cap rate, if you take that, divide that by the net operating income, you'll be actually rate times so it's that ERV. So yeah, so if you take the income divided by the cap rate, that's the value of the property. Think of that
Right.
I slash R times V. There's that calculation. But ultimately, you want to make sure you're buying market. But sometimes people get really aggressive with their exit cap. And so for me, like I don't know what the exit cap is going to be, but I use CoStar. Like I pay a lot of money for the CoStar software. And so
Okay.
we can see based on their projections. I mean, they're projecting
There.
out 5 years. So
Right.
I'm using their cap rate. So some people will be like, oh, that's aggressive. It should be this. Like nobody's going to know. And that's why we look at sensitivity analysis where we can be like, okay, well, if that cap rate's at 6, it's going to be this IRR, or maybe it's 6.25 or 6.5, or maybe it's 5.5. But that analysis, and that's why I tell investors, like, yeah, we're projecting this, but look at that analysis, because maybe if it's a 6.5, are you still okay with a 12% IRR? It's still pretty dang good. It may not be that 15, 16% that we're projecting. Maybe it's 12. And so that's where going back to the investor and communicating and understanding like their risk tolerance. As far as expenses goes, because if we break it down like the business, like the revenue is income, like rent, but it also could mean storage income. It could also mean
Laundry.
cable income. It could be laundry.
Yep.
So you're building your business plan and really seeing what the market provides. Most properties these days have reimbursed utilities. Back in the day, like a few years ago, there were still mom and pop outs there that were just doing rent, utilities included. Well, most of that is not that anymore. The syndicators have bought all that up.
Right.
So they found value add. So that's the income. The expenses is you working with your property management company. Especially if this is your first syndication, you're likely not going to be managing. The lender wouldn't want you to manage on their behalf, right? So they would want a third-party manager. That third-party manager will help you with the payroll, repairs and maintenance, contract services, advertising/marketing, utilities. They're going to help you with that expense side. They'll also help you on the revenue side, but revenue minus expenses, NOI, and then you're just trying to find really good debt. And there's risk levels on that too. Are you okay with the 75%, or you want to do 65% loan to value? If you do 65% loan to value, you got to bring more equity.
Right.
Right. And so can you bring in that equity? Or I view debt as cheaper than equity. And equity, by having a little bit more leverage, you have more returns to your equity investors. So there's different ways of looking at it. There's not a right or wrong. I always tell people, because I have partners who like want to have these debates and stuff. And I love like partners who like challenge the status quo. Like, it's good. But in the day, it's like, what is your comfort level? What's your investor's comfort level? And what are you doing to, if there is risk, like offset that risk? Maybe it's more capital reserves or more money in the bank for the rainy day. So anyway, those are things. I mean, we can go all into a whole hour on underwriting, but don't overcomplicate this for those that are listening. If something just doesn't seem right, like, how are you going to manage 100 units and only have 30,000 in payroll? Or why are you projecting 5 or 6% cap rate? Or going in cap rate, it's at 6, but you're projecting a 5 exit 5. Like, you really think it's going to be that low? And how did you come up with that? Or if taxes aren't 100% of purchase value in the state of Texas, that's where some people got really screwed the last couple weeks. They were doing, especially in properties bought in Austin, they were doing 100% or no, 80% of purchase price. Well, City of Austin found out that and this is all over Texas, the big driver in revenue are real estate taxes. So you can't really fight your taxes and say I paid less when you have to go, when you protest and you show them the contract that you paid higher than what they're. So just do 100% of taxes or purchase price for taxes. Last thing I'll say, I'm being long-winded, I apologize, is insurance.
No.
You have to get an insurance broker who does multifamily or does whatever asset class you're investing in, storage, office, it doesn't matter. Just someone's got to be an expert on that insurance and get a quote. And once you feel good about your revenue, once you feel good about your expenses, and you've got taxes conservative and your insurance, those are the two big drivers in payroll. Then you got to look at your comps and see where are they standing and what revenue can we add? Are we below market or above market? So it's a lot of work. That's why I say sometimes it's better to be a passive investor. Let us do all the work and you just enjoy the benefits, honestly.
Well, that totally leads me to my next question here, because clearly CREI, by the way, what does CREI stand for?
Commercial real estate investment.
Okay, very simple, very good. So CREI partners. For the listeners out there, clearly you have very solid underwriting techniques, and there's a lot. And you said you were long-winded, but it's because you have to be so thorough on your side. So for the listeners out there who are interested in getting into passive investing, and maybe they're looking at your company compared to 3 or 4 or 5 other companies, what should they be looking for? And I mean, clearly your stuff as far as doing the whole underwriting itself, but what are some red flags that you have seen from, say, other syndicators that the listeners really need to be aware of?
Yeah. So we didn't talk about this before, but I will do a plug. So we have a passiveinvestorcoaching.com platform where I've done over 5 hours of content for people to accelerate their education on investing in a deal. If I invest in Raleigh, North Carolina, where you are, like I don't necessarily have to fly out there to see if the area is a good area. I can use Google Maps or Google Earth to like do street view, look around, see if there's local pawn shops or if there's like bars on the outside of a
Tobacco
convenience store.
shops.
Yeah, those things like you can use those tools. So a lot of it's not rocket science, but like sometimes it's just getting the information. So, if there are people wanting to learn about passive investing or active real estate investors who want to just think differently of like how should passive investors look at deals. So it can go both ways at passiveinvestorcoaching.com, and it's free. There's no, like, it does get you all in our email system and we'll reach out for a call, but there's no stress to like invest or any of that
Nice.
stuff. So, but I would say with the red flags, it's a really great question. Just simply just getting on a call. I'm going to go much further into this, but first off, being able to get on a call with that syndicator or sponsor and just make sure it's a good vibe. Like
Yep.
we've survived our age because of our instinct to follow our gut. Maybe some of those were bad decisions, but we learned from them. But I think for the most part, like we can make a good decision if somebody is good people. My dad likes to say like good blood. Does he have good blood or not?
Yep.
And like, so that would be step one, like just getting their feel of things. And I would also say step two, failure is not a bad thing. And I think when real estate has its ups and downs, right?
Mm-hmm.
And for many years, real estate was doing extremely well. And with real estate being the original investment of all time back in the like caveman days, like real estate has existed forever. So there's going to be these ups and downs in these cycles, but how open are the syndicators talking about that experience? And what I mean by that is I've seen a lot of sponsors. I get calls from people like when we go buy a property. Most recently, we bought a property and I was getting calls from that other person's investors wondering about the status of that deal because it was not performing. And they were like, oh, I see that you're raising capital to buy this property. And it's mind blowing. I'm like, why aren't people communicating, the sponsor
Wow.
communicating of what's going on? And so I think it's important to ask them the good, bad, and ugly is part of your like
My badassery bestowment.
your,
Yes,
your intro
exactly.
of
Yeah.
it. Because if they've been in the business long enough, they're going to have failure points, right? Fortunately for us, we haven't lost capital, investor capital, but we've had one deal, like literally one deal that has like caused me so much stress and so much time. It was bought at the peak of 2022, and we pushed the business plan, and it just always been my struggle.
Yep.
But I'm open talking about it and like, hey, there was a lot of lessons learned in that, and we did a modification on the loan, and there's many, unfortunately, people, and maybe it's the Marine in me, but like I go into like challenges, right? And I always have, but some people aren't wired that way. And so you
Right.
want to find out through your sponsor syndicator, like what has tested them? Like what have they gone through? How do they communicate, good or bad? Did they put their head under a pillow? And you can get those
Right.
vibes by just having that
And
conversation.
and to tack onto that, it's how important they bounce back from those situations because I mean, it's going to happen. I just had a deal go south and we're making our lender whole throughout it, but it was extremely stressful for us, but we're bouncing back because that's what you have to do in real estate and that authenticity. So I love that you brought that up. So Wayne, any more red flags?
So so we talked about just genuineness. We talked about talking about both good and bad. I would just, if you have questions on the business plan, and I'll just leave it at this, like they'll probably have a webinar or something going through. If they don't want to share their underwriting or they're not willing to answer questions,
Ooh,
and maybe they don't need your investment. There are those sponsors, they like those easy investors that come in. It does save them time. But I mean, I think it's important to like, we're busy and we've got our set of investors, but like we spend time and answer questions. And I have hired, invested in the company, a full-time investor relations person to also be able to not only just wish you happy birthday on your birthday, like have some experience with that, but also just to be like there to answer questions or be a conduit to our company. So seeing what they're built out, are they part-time? Are they working on this? Like, do they have a full-time job or they don't? Like that was me. Like I'm not saying that's a bad thing, but who on their team is full-time? Like
right.
somebody's got to be all in on real estate. And so There's a lot more, obviously, but just from a time standpoint, I think those are the big ones. Just really trust your gut and treat this like a business.
Yes.
It is a business, and you're evaluating a business, and does it make sense or
And
not?
And one I'll tack on is you brought it up as mentorship, and are they tied into a community of other investors that they can lean on in situations where it's tough? And so I'm throwing that one out there as well. But Wayne, I went totally different direction. I had all these other questions for you, but I feel like what we discussed really is going to make a difference for the listeners out there. So if they have any questions for you, if they want to learn more about your company, how do they find you?
Yeah, so check out passiveinvestorcoaching.com. When you sign up through that, you would also get in our circles with our emails, and also
Communications.
there'll be a Calendly link where we can connect as well. You go to creipartners.com, and then there's ways to communicate to us there. But really just pushing the education aspect, because everyone listening to your podcast is obviously thirsty for education. And so
Thirsty.
whether you want passive education, active, that passiveinvestorcoaching.com, I put a lot of effort into just opening the book and accelerating learning about passive investments.
Well, I love that. I love that. And you're giving that away for free.
Yeah, it's for free. And then if you get an email and you don't like us, unsubscribe. There's no pressure at all. I don't care. I just wanted the value of like, hey, because I have a meetup. It's the fourth Monday of every month. It's a virtual meetup, and we get people all over. So I've had investors who take all 12 months, they go through our meetup, we bring in different speakers, and then they invest, and then they're like, oh, this actually is legit, and this is a K1 document, and there's paper losses, and so then I was like, man, it's taken them that long to realize like this is actually really a great thing. So
Yeah.
why don't I just do like a 5 hour or so, like dive deep, and then they
Yep.
can, if they really want to learn quickly, they can. And we go through underwriting, we go through red flag, we go
Nice.
through all of it. But no, it's just my way of, there's nothing worse than hearing from people who didn't ask the right questions,
Mm-hmm.
got in on a wrong deal, and then they lost their investment. When I'm like, man, if you could have just stepped back, listen to your podcast, Jen, or done my passive investor coaching program or whatever. So it was a really important thing for me to just put it out there for content and education.
So curious, because I've been hearing, but with you, you are more involved in the syndication side of this industry. Are you hearing a lot of shit shows going on out there? Excuse my French.
And I love it. I'm so grateful for it, because that is real estate cycles. And oh, by the way,
Right.
like this isn't just, man, now you got me going. I'm excited. So now this isn't just like individual syndicators, because think about when people buy an asset, like it goes through a lot of underwriting through the lender, an appraiser, all this stuff. And not only are individual syndicators been going through hard times, and nobody wants hard times for anybody,
Right.
institutional big clients. I mean, there was a property, they bought it for like $200 million,
Ooh.
and they got an offer for like 235 million. And this is institutional. I'm not gonna say what it is, a property, try to be vague here, but 235 million. They thought it was worth more, so they didn't sell it. Well, the market turned and they sold it for 165 million.
Ooh.
My point is like that is a major institutional client. Now they're okay because they've got other
Right.
properties, institutional, like it all balances out. But you read in the headlines where loans are defaulting off. It's like
Yep.
this is the markets. But those that are hungry and opportunistic, like think about all the people who lost their stuff in 08,
Right.
09, right? But those that bought during that time and actually charged in did extremely well. So
Yep.
I'll give you a couple of examples. We just bought a property in San Antonio, 128 units. We bought it for $3 million less than they bought it last year. And the reason why we bought it that cheap, it was a fire sale, because the lender had multiple properties under the sponsor, and that sponsor they called the loans due, so we had to force sale.
Mm.
Great for us, really sad for them, unfortunately, but great for us. And then the year prior, we did a loan assumption, 3.82% fixed rate on 128 units
Ooh.
in Houston, which was a fantastic cash flowing deal. We've done a 6% fixed rate on another deal for seller financing. So we've been really, really creative on opportunities. So look, my mentor, going back to my mentor said, like, if you feel like there's no opportunities, then there's no opportunities out there. But if you feel like there's opportunities, then you will find those opportunities. And so, yes, there is the shit show out there, but really the majority of multifamily is doing just fine.
Okay.
Majority of them are fixed rate debt, right? It's the bridge loan. It was my loan. It was 2022. I did bridge rate debt, not because I was overpaying, but because it was a long-term owner who didn't put much in the property, and my goal was to do a deep value add. So what do I have right now? I have fixed rate debt. I modified my loan. I got through it, right? And it takes that grit, and it sucks. And sometimes you can't get through it because it
Right.
is what it is. But how are you going to communicate to your investors? What are you going to learn from it? And those are the things I want people to talk more about. And so that way we're better prepared for the next go round. But there's definitely cycles. I do think we're at the bottom of the cycle. And I think if we're buying it now, things will be coming up. Doesn't mean it's easier. In fact, I find it harder. People don't seem to want to invest as much, right?
Mhm.
Because they've been
Burned.
experiences. But
Yeah.
I'm like, history shows, like, when it's down, this is the time. So
Yep.
it's just educating and not pressuring anybody. People are going to be comfortable with whatever life chapter they're in at that time.
Well, you seem so genuine to me, and I bet all of your investors, everyone who works with you, they are so lucky to have you because, you get creative. There's people who put up the blinders, and this is the only way to do it. And I love that you have some seller financing stuff and everything going on. So, Wayne, thank you so much for sharing all of that. We are going to move to the second part of the podcast. See, I skipped like 10 questions I want to ask you, but
We had a good conversation, though.
great conversation. So it was definitely well worth it. But we are moving to the second part of the podcast here, which is what makes Wayne Courreges the third a badass, which you are. And I use the acronym badass, and the first letter is B for book. So what's a book that's made a huge difference in your life?
I've read this a long time ago, but The Speed of Trust, Stephen Covey. I think without trust on team,
Oh,
things happen a lot faster. I can call an investor and not really give them a whole lot of info, but that because they trust me and that with the returns and everything that I've done for them, I can get that investment pretty quick. And so whether it's in scouting or wherever I'm doing, that Speed of Trust, that book is fantastic. It'll definitely grow teams faster and just get things done a lot more efficiently.
I got to check that out. What's the other book that he did? No,
Oh, there's so many. Yeah,
the Stephen Covey.
he's done. Oh, now I'm going blank.
No, I
But
know. I'm going blank too.
done, 7 Habits of Highly
Seven
Effective
Habits.
People,
Yes.
First Things First, The Eighth Habit. Again, there's so many, but
Yes.
that one has always, and I got that with CBRE like early in my career, and so it's been a while. But that book is always just, I mean,
Really influenced
since
you.
everything is based on trust.
Yeah.
So
People want to work with who they know, like, and trust is that third. So very well said. All right. The first A in badass is for advice. You've given us great advice, but what's the best piece of advice you've ever received?
So I got a lot of advice. One of the things, it just popped up in my mind. It wasn't what I was initially going to say, but something's telling me to say this. So somebody out there must need this. Going back to an analogy of like going to a new analogy of cooking, like you have different things cooking. Some is going to take longer, some is going to take shorter. When you feel like certain parts in your life aren't going as well as you had hoped, go to the other pot or focus on the different thing. Because the W-2, like when I was working for W-2, it did sometimes feel stagnant. I did feel like I'm not getting that promotion or I'm not getting that. Well, it's like, okay, well, my mentor, my boss, who was my GM, good friend of mine, he's like, well, focus on your family. Like if you're feeling stagnant or things getting tough at work, like put more time into another thing that's going to give you that joy and the happiness. So that was not the way I was going to go with this, but that just like something told me I needed to say that, where you're not going to have all things cooking perfectly or going well, and that's okay. That's life, but just means you just need maybe focus in on something different while that other thing is just lightly boiling.
Yes, put it on the back burner. I love all your analogies.
Thank
And
you.
I agree, because even this whole conversation went a totally different direction, because I felt people needed to hear other things about you than what the chat GPT came up with for questions here. So, all right, the D in badass is for drive. What drives you to be successful?
Mm. I've got mouths to feed. I've got three amazing children and an amazing wife and team members. They depend on me to lead, and it's ups and downs, and it's not
Mhm.
always perfect. I mean, but for the most part, if we keep doing base hits, we're going to win the game,
Very
right? We
nice.
don't have to do a home run. I'm just like pulling all these guys out. Boom. I'm like, what did that came out of nowhere? But I'm like, yeah, you do. You just that's all you need is a base hit every day.
Love it.
So
I
that's what we're trying to
my
do.
my big analogy is the bus. That's my business, and I'm putting the right people, the right seats on the bus. So that's my analogy, and you're going to steal that for your next podcast you
Like that
watch.
one. There's a book on that, isn't there? I feel
Is
like there's.
there?
I have it in my garage. I'm gonna email you this bus.
Awesome. That is funny. All right. The second A in badass is for aspiration. I'm a big goal setter. So, what is a goal you are currently working on?
Well, we are about to do an 8-month RV trip with my family. So
Stop
the
it.
goal is in progress, but that is something we have been talking about forever. Even back when I was working for with CBRE, was to do a so my son, he goes into 8th grade this year. I've got a 13, 12, and 10-year-old. So I was like, hey, if we're gonna do this, we need to do it now because I don't want to do this when he's in high school.
Scott, right.
It's high school. So yeah, I've got Fridays are going to be travel days and we're going to be going, and that's the power of real estate and entrepreneurship. And yeah, I've worked my ass off for all these years to be able to get to this point. So it's not something I could have done early on. Maybe I could have. Anybody can do anything, but with my risk tolerance and what I was willing to sacrifice, like this is a great time to go do that. So that's a huge aspiration just to get through it. We're not selling our house, we're not renting our house, Jen. So like if we just don't like it or something comes up, we can leave the RV there and fly home or turn the bus around and head home. So that's one, but honestly, I want to continue doing great deals for my investors. I do think I do. And this is, I have a mindset coach, and prior to this call, I was with my mindset coach. And part of those things is like, you want to feel like you're doing the right thing for your investors. And I want to keep finding good deals and deals meaning like there's some sponsors out there doing like monthly. Like, I'm like, how are you doing all these deals and still operating them well? Like, we want 2 to 3 good deals a year
Yep.
and operate and execute well. So that's an aspiration. It's just keep doing good for our investors, and everything else will come along after that.
Well, going back to the RV trip, what are the destinations that you have on
Yeah.
the list?
So my wife's from Montana, so we're going to start in Montana, Missoula, and then so every Friday's travel day. So we're there every 1 week at a time in every location. So we start where we live, Central Texas, head up to Montana, spend there, and then we're going to go to Jackson Hole, Wyoming.
Nice.
Super excited. We're going to do whitewater rafting, go check out the Tetons and those things. And then we're going to head over to South Dakota to go to Mount Rushmore. We've been to Mount Rushmore, but my kids can't remember anything we've done in our life. Like, I'm like, you've done so much already. You don't remember. So we're going to go back to Mount Rushmore. And then from there, we'll keep going over to Michigan or Illinois, Michigan, head up to Vermont, go down to like New York and just Carolinas. I'll be in the Carolinas. We'll be in Florida for most of the December, and then we'll head up. And then one of our last stops is the Grand Canyon. So we'll head up to Arizona, do the Grand Canyon, which is something I've always wanted to do, and then back to Texas. So
I love
that's
that.
that's our in ChatGPT. You mentioned that it created my whole plan.
Wow.
My plan is to work Monday through Thursday, like heavily in the mornings. The kids will be in school, like they have an accredited online homeschool program that they're going to do. And then
Good.
the afternoons we're going to explore. And so, yeah, super excited about that. That was an aspiration that it took it took a lot of time to get to this point where we would be able to do it. And I've got great team members and I'm just excited for it.
Well, it is on my bucket list as well. Are you going to buy an RV or are you going to rent one?
So we've always had a travel trailer, like always.
Okay.
But my kids cried when I initially told them because they were like, I do not want to live in that for 8 months. So that next morning, because I was feeling really guilty, like, oh, maybe they don't want to do this. We went and bought it's a Class C motorhome.
Ooh.
I can't get a Class A just yet. One day, maybe that's another aspiration, but a Class C, which is fantastic. It has bunk beds. There's a bed over the cab, a full slide out, and then we bought a Wrangler to tow behind
The
the the
RV.
So
Yes.
yeah, those should be, it
So
should be fun.
cool.
Oh, and we talked about this with dogs, but I have a Great Dane and a Lab, and they are coming with us too. So it's going to be insanity. That's why I'm not renting or selling my house because who knows how this will work. But they are coming. They're older, and so that's important for us is bringing them along.
Well, I work for a coaching program called Rental Property Pro, and we have to do our strategy in the beginning, and you have to write out there, write into it what your why is. And I said, within 5 years, I want to own an RV named Artie. By the way, I've already named him Artie,
Love it.
so that I can travel. And I want to go to Canada. One of my bucket list items is to go around Lake Louise and to take our dog. So we are right there with each other.
Love
We went off on a total tangent with that as well. So going back to the acronym here, thank you for sharing all that. Is the first S in badass is for systems. What systems do you have in place to help you achieve success?
Oh gosh. So there's a book, Buy Back Your Time. That's another great book.
Okay.
And I structure my days so I have focus days, buffer days, free days. So that's one structure personally
Say
that
that
I
again. Focus
focus
days.
days, focus days, buffer days, free days.
Nice.
So my focus days are Monday, Wednesday, and every other Friday morning. And so those are like company generating things that I do for my company. I don't
Okay.
respond to emails. I don't do anything but focus on the business to growing the business. That could be talking to investors, whatever it is to grow revenue and the bottom line for the business, looking for deals, underwriting. Because what I find is sometimes you get so cluttered and you're not in control over your day because you got team members coming and asking for things. And you're like, come Friday afternoon, like I did nothing to grow the business. I've been working for the business. So
Right.
those are days my assistant, my team, they know like Monday, Wednesday, Friday, every other Friday morning. Tuesday, Thursdays are buffer days. We're doing this call on a Thursday. Like these are days that I can do calls, I can do podcasts, I can do team meetings. We do every other week team meetings. And that's when I respond to my emails that I need to respond to because my team member, she'll respond to emails that doesn't really require me. It may be in my inbox, but doesn't mean I have to respond to it. So it just buys back time. So read that book if those are interested. So Tuesday, Thursdays, and then I do every other Friday off. So that's my free days, and I completely unplug and go from there. So that is a system that has really worked for me. I started that in 2025. So that's not something I've done forever, but that's something I've really instituted this year after reading that book. The other things too is just our portal. We talk about cash flow portal. So like our CRM, our deal base, our updates, all that's in one place. So, and there's others like Active Campaign. We have other systems, but I think people looking for ways to like find time and get control over their schedule and not have email control your schedule. Like so many people like, and I'm guilty of that. Like for a while there, my anxiety was like, oh, I need to respond to this email right away. It was like,
Right.
no,
Yep.
I mean, you don't have to respond right away and you can control. So that book even talks about a filing system with emails.
Woo.
I've, I've done that filing system. My team member sorts things based on that and responds. And it's been such a blessing.
I just wrote that
I've been able
down.
to I've been able to grow the business because I've actually had time to grow the business, and I've been able to like focus on other things because I have time slots for that.
I love it. I had to write that down so I get that book because I need that. So I could talk to you all day,
Let's do
Wayne.
it.
We have so many great connections here, but the final S in badass is success. What does success mean to Wayne Courreges the third?
Oh, different ways of success. I think lately, I took my son. I'm a scoutmaster, so we went on this scouting event to Sea Base in Florida. And there's these full life, like my dad went with me to a lot of these scout camps. And so now I'm going with my son. And so I'm starting to see like these full circle moments.
Aw,
So right now it's pretty cool to like, and I don't know if I took him to a movie the other day. He thanked me for the movie. I took him to Florida and I got no thank you. So I think in some days I'm like, I don't even know if he really wants me there, but I don't really care because later in life he's going to be grateful that I did show up. So yeah, that's what success is. It's showing up,
very
showing
good.
up, whether it's family or investments or good or bad, whatever it is. Um, the other thing too, I'll try to be really quick with this, but I define wealth not by like the zeros that are in your account, but just by your freedom. Like if you are bringing enough passive income to cover your bills and live where you can just be free, like you're wealthy. Like So many people are so focused on like, oh, I've got to be 10 million before I retire. It's like, man, if you can, I mean, if your investments or your outflow with everything is 5,000 a month and you're bringing in 5,000 in income passively, like you're doing pretty well. So
Yep.
I think we need to give ourselves some little grace on really what we consider success from even a financial standpoint. Is financial freedom doesn't mean to have all those zeros. Passively
That's
invest,
true.
offset your expenses, and you're free.
Absolutely. Well, showing up is fabulous. And I appreciate you showing up here for this podcast because this has been so great. You are so good at explaining things and really breaking down those mysteries behind syndications. And I just do truly appreciate you being here today. Wayne, thanks so much for being here.
Jen, appreciate you having me.
Absolutely. And that is all. Thank you for listening. We will catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.